Welcome to the BDO Tax Support for Professionals webinar program. My name is Chris Holmes, and today I'll be your guide through the key legislation, tax planning, pitfalls, practicalities of capital gains tax loss relief. This presentation was recorded on 19th of May 2020 and is based on the law and practices as at that date. If you have any queries or observations on the material contained in this webinar, do not hesitate to email or telephone me or any of my colleagues whose contact details are on the final page of this slide pack. Before we dive into the material, a brief word about BDO Tax Support for Professionals. We're providing proactive tax advice to accountants, lawyers, and in-house tax teams for over 30 years. We're all professional tax advisors and know that sometimes you just want to clarify or confirm your thinking, or even perhaps need to reach out for help. This is when the TaxLine telephone helpline is there for you. For larger projects, we're able to help you scope out the work required and to assist as much or as little as you require, including providing formal written advice. We're able to provide an upfront free quote so that there are no surprises. If you would like to find out more, do visit our website at bdo.co.uk/TSP, where you can also sign up to our free weekly newspaper. Alternatively, just call 0845 356 0006. We are here to help. And now, without further ado, let's get on to the webinar. As I'm sure you'll be aware, the standard rules for relieving capital losses is first against gains of the same year, and once net gains are reduced to nil, excess losses are carried forward and set against first available capital gains of future years. It is worth noting that for carried forward losses, they reduce net gains to the level of the annual allowance and not down to zero. And where gains of a year are charged at different rates of tax, relief is against gains subject to the highest rate of tax first. If your client has assets sitting at a loss, there are few opportunities to crystallise those losses, except as a sale to a third party. Bed and breakfasting of shares has not been available for many years, except where the replacement shares are acquired through an ISA. We are now going to work through a number of special cases. If your client has recently sold their business, the deal may have included some kind of earnout, which has now become irrecoverable. Where the deferred consideration was ascertainable at the completion date, it will have been included in full within the capital gains computation for that disposal, and tax has already been paid on the now irrecoverable amount. Relief is available by amending the original capital gains computation and reducing the consideration therein. Interestingly, a gain can be amended even if 4 years has passed and the tax return has otherwise gone out of time. In contrast, the chosen action that is an ascertainable consideration is a separate chargeable asset. It will have been valued on the date of completion, and that value included consideration for the original gain and tax paid thereon. The settlement of such an earnout is disposal of the chosen action asset in the year of settlement. A capital loss will arise if the amount received is less than the value placed on the earnout when acquired as consideration. Relief for this capital loss is available in the normal way as a loss in the year of settlement, but additionally a claim can be made to carry back the loss against the original gain. Clogged losses is a phrase found in the legislation dealing with disposals to connected persons. As you will know, such disposals are deemed to be made at market value, and if as a result a loss arises, relief is only available against gains arising from other disposals to the same connected person. This should not be forgotten when advising clients who may now be looking to pass assets to the next generation whilst values may be suppressed. Special rules apply in limited circumstances where loss arises on a disposal of shares. Share loss relief provisions allow relief for the capital loss to be claimed against total income, giving relief at the higher income tax rates. EIS and SEIS shares always qualify for share loss relief. However, the relief is also available for shares in some unquoted trading companies. In addition to the need of being unquoted and trading, a number of other conditions apply for the company that will need to be checked before making a claim. The shares themselves must have been acquired by way of a subscription, so the relief will not apply if purchased from another person. EIS and SEIS shares must be subscribed for cash, and many mistakenly think that applies here. Instead, share loss relief is available where the subscription was for money or money's worth, which is a slightly wider definition. When considering share loss relief, we must remember that in calculating the capital loss on EIS or SEIS shares, we must reduce the loss by the quantum of income tax relief claimed when the investment was made. Also, for non-EIS SEIS shares, the general restrictions for income tax relief apply, i.e. maximum relief for the year of £50,000 or 25% of income. And it should be noted that partners cannot claim share loss relief for investments made by the partnership, as the individual would not have personally subscribed for the shares. In our experience, when HMRC inquire into share loss relief, they pay particular attention to the precise mechanism surrounding how the shares were acquired, and relief can be denied for a plethora of reasons. You should therefore carefully review the circumstances before helping your client make a claim. Negligible value claims is another area which is commonly misunderstood, and we do receive a lot of questions to the tax line on this subject. The key points are that the shares must have become of negligible value during a person's ownership, and that the asset must still exist and be owned by the taxpayer at the time of the claim is made. For this purpose, the courts have determined that negligible value means worth next to nothing. Many older practitioners still think that negligible value means less than 10% of cost, which was HMRC's guidance for many years, but that is not the case. Negligible value claims are best illustrated by an example. A company ceases to trade and is placed into liquidation, and the shareholder is told that they will not receive any monies. At that point, the shares should be of negligible value. In the ordinary course of events, an actual disposal will occur when the company is formally dissolved by the liquidator and the shares cease to exist. A capital loss will therefore arise on that date. A negligible value claim could be made before the date of dissolution to carry the loss back to the date the shares became of negligible value, providing that was within 2 years. Points to note are that a company going into liquidation does not necessarily mean the shares have become of negligible value, and it needs to be accompanied by a communication from the company or liquidator that a distribution is unlikely. Furthermore, a claim is only valid if made before the company is dissolved, as the shares will not exist beyond that point. Again, it is important to delve into the facts before helping your client make a claim. In this final section, we will look at partnerships. If a partnership sells an asset at less than cost, then each partner will be allocated some of the resulting capital loss, in line with their fractional entitlement to that asset. Otherwise, the rules governing disposal between partners is set out in Statement of Practice D12. We note that all claims for CGT purposes must be made by individual partners. Section 42 of TMA lists those claims that are made by the nominated partner, and that list makes no reference to TCJA at all. A not uncommon question to the tax line is around partners withdrawing and not receiving back all the monies they had initially invested in a partnership. In order to determine the extent of any capital loss, it is first necessary to examine the mechanism of their initial investment. To the extent that they had previously acquired goodwill, that is a chargeable asset, and if it is sold back to the other partners at less than cost, a capital loss will arise. However, in most cases, funds have simply been contributed to a capital account, in which case no relief will be available if it is not received back in full. This does make sense, as there would need to be a reason why the full amount is not returned. Reducing a partner's capital or current account balance usually involves the allocation of a loss for which tax relief will have previously been received. Therefore, to allow loss now would duplicate relief already received. That said, if a contribution was originally structured as a loan between the partners and the partnership, which is possible in law, then a capital loss under the loan to trader provisions may be available. Thank you for watching this presentation. Should you have any questions, please call the helpline or call or email myself with the contact details as provided here. Alternatively, feel free to contact any of the TSB contacts listed here. Thank you.